Hi, and welcome to this week's market presentation. Latest news. In the latest news, the war in Iran approaches the 1-month mark as the conflict continues to escalate. Over the past week, Israeli airstrikes targeted Iran's South Port gas fields, which led to Iranian missiles attacking Qatar's Ras Laffan LNG facility. Qatar Energy CEO stated that roughly 17% of the facility's LNG export capacity had been destroyed, with 2 liquefaction trains suffering extensive damage. It is being reported that the estimated time to resume production will now be 3 to 5 years and will cost billions of dollars. After strong backlash from markets, in particular, the US pressured Israel to announce that it would no longer target energy infrastructure in Iran. Nonetheless, Israeli airstrikes against Iran's energy infrastructure have continued. Prices continued to increase, particularly in crude oil markets, as concerns over the war extending further with no end in sight continued to impact markets. At the same time, the impact that the war is having on the global economy was also felt by financial markets, with US stocks seeing further declines week over week. In a further escalation in the war on Saturday evening, President Trump stated that unless Iran fully opened the Strait of Hormuz to transit, that the US would retaliate with significant damage to Iran's energy infrastructure, with threats that the US would conduct airstrikes across the country. In response, Iran announced that any further attacks by the US on its energy infrastructure would open up Gulf countries' own energy infrastructure, and particularly desalination facilities, as fair targets by Iran. As the deadline continued to get closer through Sunday, concern amongst markets increased further and further. Fortunately, Sunday afternoon, President Trump tweeted out that he was pleased to report that the United States and Iran had over the last couple of days productive conversations regarding an end to the war. Iran's foreign minister and government officials denied that any negotiations were taking place, but nonetheless, the statement by President Trump, which included an extension of his ultimatum to 5 days for talks to continue, eased the tensions amongst financial and energy markets. That was seen most noticeably in crude oil markets, as we'll see later, where prices dropped noticeably throughout this Monday. Nonetheless, even with the extension by President Trump and the ongoing negotiations, as stated by President Trump, military activities continue in the Gulf, with the US and Israel continuing airstrikes against Iran. Over in Europe, EU leaders met to discuss the energy crisis and competitiveness on March 19th, with European Commission and key members ultimately reaffirming their strong support for the ETS, while at the same time being open to discussions on improving the competitiveness of the European Union's industrial and manufacturing sector, with discussions including potential gas price caps, as well as adjustments to the EU ETS framework, such as loosening the free allocation rules. European Commission President Ursula von der Leyen then promised that the upcoming ETS revision, scheduled for July, will also set a, quote, more realistic decarbonization trajectory beyond 2030. Initial talks of reform caused European allowance prices to fall to 11-month lows, and with the European Commission backing the ETS market as a whole, it did prompt a rebound in carbon markets so far this Monday. Nonetheless, the prospect of revisions to the ETS market that could loosen some of the current tightness in the market, continuing to add some downward pressure on carbon allowance prices. Weather. Beyond the latest news, in terms of the latest weather forecasts, temperatures across Europe are forecasted to remain close to the seasonal average and continue the relatively mild weather we've been having over the past couple of weeks. Precipitation is expected to be rather limited across most of Europe, and wind speeds are expected to start picking up over the 7 to 10 day period. Microeconomics. The latest inflation figures for the euro area were released for the month of February, which showed year-over-year inflation remaining relatively steady, increasing by just 0.2% and still below the 2% target set by the ECB, while core inflation increased slightly to 2.4%. Looking forward, we'll certainly start to see an impact of the increase in oil prices on inflation across Europe. Depending on how long the war lasts and how long those prices stay elevated, the impact on inflation could certainly be more pronounced. Crude oil and LPG. Speaking of crude oil prices, as we noted earlier, overall continued bullish price evolution for crude oil as flows through the Strait of Hormuz remain closed and as no end to the war appears close. Nonetheless, as I mentioned earlier, we did see a decrease in the price level today, with Brent crude oil prices decreasing from $112 per barrel, as we saw last Friday, to just over $100 a barrel today. Natural gas. Moving towards natural gas pricing, TTF gas prices continued the bullish price evolution, with the front quarter up another 20% over the past week, the front year up nearly 24% on the week. Since the beginning of the war, the increase in the price level had been more pronounced in the short term, with expectations that the war would not last very long and that flows would quickly resume and supply would be restored. Following the attacks by Iran against Qatar's LNG facilities and the damage to roughly 17% of Qatar's LNG export capacity, we are starting to see upward pressure and further along the curve as the war is starting to have longer-term impacts on global LNG exports. Besides the war in Iran, storage levels currently another important factor impacting natural gas prices across Europe. Over the past week, the favorable weather conditions have led to near the smallest withdrawals from storage over the past 13 years, which has helped reduce the deficit of storage versus the previous year and the past 13-year average. With storage levels now around 29%, we're looking now at just around 6% below last year's levels and now around 10% below the past 13-year average. Nonetheless, given the disruption of flows from the Middle East and the expected price competition for remaining global LNG supplies, it will certainly be more difficult to refill storages this year as long as the war continues. In terms of total supply and demand, we see the weaker total demand near the bottom of the past 5-year range, primarily driven by the milder weather we've been having across Europe, but also how the spike in natural gas pricing is already leading to some gas to coal switching from the power sector. The supply picture has so far remained a little more stable, but we're starting to see the impacts that the halt of LNG exports through the Strait of Hormuz is having on the European supply mix. LNG sendouts have already began decreasing, but it must be noted that when we look at LNG imports into Europe, so far those flows had been continuing as they had left the Middle East before the start of hostilities. As the war continues, we'll start to now notice a bigger impact in terms of the decrease in world LNG exports moving forward and start to more directly influence Europe's security of supply. Global competition for LNG has intensified, as shown here, with Asian natural gas pricing increasing drastically over the past week and remaining at a premium to that of European gas pricing as Asian consumers fight to replace their lost Qatari LNG flows. Coal. Coal prices continued their upward movement over the past week, with pricing increasing between 6 and 8% globally. The upward movement in the market very much driven by a renewed increase in and coal demand, particularly out of Asia, as consumers start switching from using natural gas and using coal instead. And over in Europe, we also note the fact that we are starting to see an increase in coal consumption as well. While at the same time, NRA coal stocks are now at a record low. EU and UK emission allowances. Regarding emission allowances, here we note the bearish price evolution we had noted throughout the previous week across the EU and UK carbon markets. But as we noted earlier, following the statements by the European Commission, pricing saw a rebound this Monday, with both the December 26 products in the EU and UK markets seeing a rebound there. Looking at power sector emissions, the milder weather is certainly helping ease total emissions from the power sector, now near the lowest levels over the past 5 years. However, the emergence of gas to coal switching is certainly to add some support for overall emissions. Investment funds, which had seen the number of long positions decrease across the European market due to those reports of discussions about easing some of those regulations, have seen the level of net long positions ease down over the previous week as well. In the UK side of things, even though no further details have been reported on regarding the linking of the EU and UK carbon markets, that prospect continues to add upward pressure on UK carbon pricing and future investment fund positions. Electricity. Electricity prices saw a further upside over the past week following the increase in natural gas prices across Europe. The decrease in the carbon price blunting some of the bullish sentiment due to the increase in gas pricing, although the rebound in carbon allowance pricing seen so far today could add additional upward pressure to electricity prices in Germany and across Europe. In terms of total demand and residual load, there again, the favorable weather conditions have continued to decrease total grid demand, while the strong performance from renewables has weighed on residual load as well. Looking at the supply mix, while European nuclear power generation in total remains near the bottom of the range due to the retirements, looking at still operating nuclear capacity, especially highlighted by French nuclear power output, we see output near the top of the range over the past 5 years. Renewable generation has been performing quite nicely over the past week, near the top of the range over the past 5 years, which has helped ease fossil fuel power demand to the lowest levels in over 5 years. The increase in renewable power generation has primarily been driven by the record levels of solar power output over the last few weeks, while wind power generation remains more closely in line with the past 5-year average. In terms of hydropower output, the hydrological deficit, particularly in the Nordics, continues to weigh on European hydropower output. Fossil fuels, while we know that fossil gas generation is now at the lowest levels in at least the past 5 years, we are starting to see an uptick in coal-fired power demand as we get some gas to coal switching, as mentioned earlier. Looking at hydro reservoir levels, we know the deficit most pronounced in the Nordic region there, but also in France and in Italy. Lastly, looking at the price evolution for guarantees of origin, there we've seen more limited movement over the past week, with pricing finding support by strong compliance demand and the persistent Nordic hydro deficit, while on the other hand, the record levels of particularly solar power output improving the total generation outlook. So far in 2026, total renewable generation remains slightly below the levels that we saw in 2024. Solar power output continues to remain at near record levels, slightly higher than in 2025, while hydro and wind output remain still below the record output we saw in 2024. That covers this week's market presentation. Thank you for joining.